Good morning, ladies and gentlemen. Well, the risk dial is about as high as it can possibly get, so there is absolutely no reason to prefer bonds over equities, and we are in just about maximum risk on. What I find interesting actually is how closely this period of risk on is matching the performance of the average period of risk on. And as you can see, it is indicated that really equities are going to outperform a little bit more, 3, 4, 5% more, and then have a period of sideways over summer and then keep on going. And really, you're looking for this kind of area to even start thinking about a period of risk off. And that is another, 100 days away. So, you're looking for late summer potentially to have some periods of instability, and that is also what volatility is saying. So for the time being, absolutely no reason to prefer bonds over equities or to be worried about the state of risk. Well, what happened in the bond market this week? It was a very puzzling week to me because let's recap what Wallace said, and that naturally was parroted almost word for word by Jay Powell. He said that they were waiting for the revisions to CPI, which we got on Friday, and which were a zero revision. And why did he want to wait for that? Well, to make absolutely sure that inflation was indeed where they thought it was. Because last year, after the revisions, they realized that inflation was nowhere near where it was, and then we had this period here of rising rates. And as you can see, rates rose from about 440 all the way up to 510. So we had 70 basis points of higher rates, and then we had the episode with SVB where, this was unwound, but as soon as SVB was over, we went back to where rates were. So the first box has been ticked. Inflation indeed is where they think it is. And then Wallace said, yes, well, after that, we want to see 2-3 months of 2024 figures, and the first inflation print that we get for 2024 is on Tuesday, I believe. And we're looking for 0.3. Okay, so what happens if we get 0.3 or 0.2 on Tuesday? I just think that the whole yield curve should be flattening, because it's another data point which says to them that yes, they can ease, and they can ease according to their dot plots, which is 75 basis points in 2024 and 100 basis points in 2025, which gets you to Fed funds somewhere around here, 3.5%, in which case this differential between twos and Fed funds cannot possibly hold, but twos are going to trade somewhere near Fed funds, i.e. down in this range here around the 370 area, something like that. I would have thought a 20 basis point spread would be, the normal kind of spread. But in any case, that is the situation we're in, and it really puzzled me, the price action that we had on Friday, that the market really did not, neither did the curve flatten, nor did the individual contracts along the curve get bid. That to me was surprising, and every time I'm surprised, my ears prick up, because the market is telling us something, and I don't know what it is at the moment. I have to be, completely open with you. I have absolutely no idea what the market is saying. One of the possibilities of what the market can be saying is that why should I play around in twos, fives, tens, whatever, when I can just buy QQQ and make a lot more money. That's one possibility. The other possibility is that the market does not think that they will be able to ease as quickly or as far as the dot plots imply. And let's have a look at why that might be. All I can think of is this, that the Atlanta GDP estimate is over 3%. And let's not forget how they arrive at their dot plots. They have basically the Taylor rule, which says that for every, 1% of GDP higher than the estimate, they should have rates about a third of that higher than in the previous dot plots. So if they thought that for 2024 GDP was going to be 1.2, 1.3% as they had in the dot plots in December, and it actually comes in over 3%, by rights they should be taking away at least 25 basis points, in cuts from 2024. Now that is, a real danger now, that even though Wallace said what he did and Powell repeated what he did, is that in the next March meeting of the FOMC, they reduce the amount of cuts from 3 to 2. And that would naturally hit the front end the hardest, and the yield curve would flatten. And that is actually what is going on at the moment. Not only that, but people are abandoning the bond market and buying risk assets like QQQ, which makes sense, and we'll look at those spreads later. But that is one of the possibilities of why the market is, the bond market is reacting the way it is. So back to the bond market. Now, after those revisions on Friday, I expected the market to close at the lows in yield, and actually for the week, and actually closed at the highs for the week. We can actually change that to a weekly so you can see exactly where we are. It seems to me that CPI will naturally decide where we're going, but if the market is afraid that we are going to have at least a 125 basis point taken away from the dot plots, we should be going back up here towards the 475 area, and naturally the twos should be hit the most. But the whole curve is more or less moving up in tandem. What to think of that? All we can think of is that we are doing some kind of an ABC, and we're looking for higher prices. But to me, the 5s through 427 is very, very unlikely unless we are taking away one of the dot plots. Could the market be already expecting that? It could. And, I'll be wrong, but I just can't see that if inflation is very well behaved and that they are really going to worry that much about growth. But there you have it. So I could easily be wrong in my expectations of higher prices in bonds. We could easily go and trade this 423 to 427 area in 5s, and that is probably where I'll try and make my next stand. It could be wrong, but I just can't see that I think it's too early in the year to conclude how strong growth is going to be, and therefore to start speculating that they might take away one of the cuts that they penciled in. I think it's an election year. I think that they would be loath to do that unless there is some inflation associated with it. And I think that this kind of level, 427, is where we can make our next stand. And what really interests me is that the curve itself has not really done anything. You know, you would have thought that if the market was expecting that, you would have had a significant flattening. And we didn't. 2s10s actually steepened a couple of basis points. And, 5s30s did next to nothing. Like, what is that? A basis point, two? So that doesn't make sense to me. And unless the yield curve starts steepening considerably, then I really can't see that that is what the market is saying. I think it's more a question of neglect and the fact that everyone knows that the supply of coupons is going to be large and stay large over the course of this year and next, that is prompting this apathetic response in bonds. I think that if inflation is well contained, they will ease just as they have indicated in their current dot plots, that they will maintain those current dot plots. But the problem is that the market is already through those dot plots. So it could easily be that the really simple answer is that the market is going sideways, and by going sideways, it's catching up to their dot plots and taking out the excess that it had priced in. Now, if there's one market in which we can all agree that the Taylor rule about higher GDP growth would not apply, it's Europe. And yet Europe went up higher in yield and matched the move in the US absolutely more or less tick for tick. Is it likely that it's the fear of the Taylor rule that is making bonds go up? Well, to me, that is illogical in Germany. And Germany and the US, as I just said, have been trading tick for tick, more or less, and we'll have a look at that in a bit. So what does that tell me? That tells me that if we see the Schatz around these kind of levels, around 285 to 288, risk reward becomes overwhelming, that we've done some kind of an ABC and then we have to go down again. If we look at the 10s, what kind of levels are we looking at? Well, we're looking at something like this, and you can see all these lows and highs matching this kind of level that you're talking about 250, and we're only 13 basis points away. That probably is the kind of level where you want to make a stand. Unless and until inflation starts, I won't say accelerating, but I will say disappointing on the monthly prints, I really don't see why the market should go any higher than those levels, because at the moment, if we do trade these levels, we will not be ahead of what the ECB has said, nor what the Fed is saying. We will have basically given back everything that we'd priced in over and above of what they have said. And in that case, I think the risk reward really has to be overwhelming at those levels that we return down at some stage. And this is now the differential between the 10s, but the picture is exactly the same in 2s and 5s. As you can see, we're closing the week exactly where we closed the week before, like 1 or 2 basis points different, and the range of the differential was very, very low indeed. So basically, they're trading tick for tick, and what happens in the US happens in the Bund, and what happens in the Bund happens in the US. That, to me, does not make any sense if it's the Taylor rule growth that is the problem in the US. In that case, it's definitely not the problem in Germany. If anything, every single figure that comes out in Germany is weaker in real terms of growth, and therefore this spread should be going out, and it's not. So that tells me that if the Taylor rule is the fear, and I can see how it can be, okay, I mean, theoretically, it definitely should be a fear, I don't think it will be because, as I said, it's an election year, and I think they would be absolutely loath to change their projection in the dot plots unless inflation is a problem. Then this should start moving out, or at least the odds of Germany performing better than the US should start rising. And therefore, if you look at the previous segment, you will see that those levels around the 50 area in yield in the bunds should be theoretically where you make a stand. I'm just trying to triangulate what the various bond markets are saying, and they're not making sense at the moment. And that is why I'm quiet, because I want to have a fat pitch, and I'm just not getting the information that I need to be confident that my pitch has the highest probability and risk reward of success. I just wanted to show you a weekly chart of the oats. The French market tends to work technically very well. It respects levels very well indeed. And I'm looking at this area between 296 and 313 as the area that I would like to make a big stand in Europe. I just think that the odds of us going through 313, if we close through there, I will definitely be out. But in this area, I think it's very well worth making a stand. If CPI continues not to disappoint, I think the odds of us staying in this range or busting it to the upside is very, very low. And we're very close to it. We are 6-7 basis points away from the beginning of it. And there, I think risk reward really says that you want to be long. The dollar did exactly what I thought it would do. It got up to about 104.50, which was my resistance level, and then it backed off, but in a very, very narrow range. What is it likely to do? Well, it's likely to maintain these narrow ranges while and until the differentials start moving. And as you saw, the differentials in interest rates really are not moving at all at the moment. They're tick for tick. And that tells me that this kind of behavior is going to continue. But eventually that starts favoring a higher dollar, a stronger dollar overall. I just can't see that it's going to happen next week. But I think the fact that, as I showed you in the differentials, that the risk reward is now turning towards being long of Europe as opposed to being long of the US because of the possibility that the Taylor rule affects the US, but that really doesn't affect the ECB, which basically means that the ECB will go first or go further at some stage. To me, that indicates that dips in the dollar are not going to be sustained, and that if you see this kind of level around the 103.20, that is probably as low as the Dixie can dip before it starts moving up again. What kind of level is that in Euro USD? Well, it's this kind of level, isn't it? It's 108.80. I think if you see that kind of level, I think it's a very good risk reward short for an option play. Something like 108, 109 down to 105 over the course of a month. I think that is more likely to happen than not. And gold doing the same thing. Basically, it can't get off its arse simply because bonds are not allowing it and the Dixie is not allowing it. I can't see any change here, anything much, any reason really to start getting long of gold. And let's have a look actually at what the change in the Taylor rule would imply for gold, and why I think it's unlikely that it's the Taylor rule. So let's have a look at TLT over gold and gold over tip as well, because there's something here which doesn't make sense. If the market is saying, I'm afraid of the Taylor rule and rates are going to stay a lot higher for a lot longer, or the Fed is going to take a dot plot out, an easing out of its dot plots, that basically means higher for longer. In that case, either TLT or TIP should start performing much better against gold, and neither are. What is the logic here? Well, either higher growth is going to keep inflation higher for longer, and TIP gives you 2% over whatever CPI is. So let's say the market is saying, okay, higher growth means higher inflation, or inflation not coming down. Okay, so what is inflation? Let's say that is 3% plus 2, it's 5%. So TIP is yielding you 5%. Then let's say, okay, TLT is going to go higher in yield because of the same factors. They're not going to ease, there's a lot of supply, and that would, to me, indicate that, gold is going to get sold, because why would you have gold when you can have 4.5%, 5%? Unless you think that inflation is going to start accelerating and the Fed is not going to control it. To me, if they do take out the one of the dot plots because of the one of the easings in the dot plots because of the Taylor rule, that should really slam gold against everything, because it will mean that they are being far too restrictive, and they already say that they are restrictive. And they are then going to say that, we're going to remain more restrictive. And that is just not happening in either TLT gold or gold tip. It's remaining very, very steady. And if the market were to think along the lines that I've mentioned, that the Fed is going to remain much more restrictive for Taylor rule reasons, then gold would be making a move down against those assets, and it just isn't. And that's why I just don't buy it for now. Now, if gold starts moving up against everything, then it must be something different. But gold has to move down if the Taylor rule is going to be applied, and it just isn't at the moment. And the other reason why I don't believe that growth is going to be such a huge problem, or that inflation is going to be a big problem, is because DBC is just not getting off its arse. And you can see I've been saying since weeks now that this 2175 area is hugely important. And what is the market doing? Well, it just keeps on getting down to 2175 and bouncing not very convincingly off it. If it keeps on going sideways here for another 3 or 4 weeks, it's basically saying that the commodity sector overall is weak. Don't forget, DBC is 60% energy, and at the moment the only thing that's keeping it above this 2175 area is actually oil. And, let's have a look at that. It's not exactly impulsive to the upside, is it? It just comes down, goes back up, comes back down. But until and unless it starts breaking these levels, 79 at the very, very least, we are really not looking for a change in trend in oil. We're just looking for a market that's going sideways and being somehow supported at low levels. But it's not a market that's running away with itself. And therefore, while this situation remains, while we're having, oil within 2 or 3% where it started the year, it's terribly unlikely that we're going to get a pickup in inflation or a pickup in growth. I also find it very hard to believe that we can have a worldwide growth spurt without copper showing any signs of it. And if we look at what copper has done since the beginning of the year, it just had a couple of false starts and it's now significantly lower than when it started the year. Here it is where we started the year, around the 390 level, and we're now at 360. That is, that is the opposite of a growth spurt. I just can't see that the Taylor rule is the thing that the Fed is going to invoke to take away dot plot cuts that they already have penciled in. I think it's far too early, and I think that the bond market at some stage, if inflation and the CPI prints are well behaved, is going to turn around, and principally in Europe, because it just does not make sense from everything else that I'm looking at that it triangulates into higher growth. Maybe higher growth in the States, maybe risk assets in the States perform considerably better and therefore the bond market is being avoided, but at some stage that has to stop. To me, Europe is actually more interesting in equities than the US is at the moment. I don't think that this trend is going to stop until we reach 48, 49. And that is a level that goes back to the 2000s, and which I don't have on this chart. So I think there is absolutely no point in even trying to oppose equity rallies until we get to 48.50, and we're at 47.30, so that's another 100, so that's 2.5%. Assuming that there isn't a huge divergence in performance between the European market and the US, there is at least another 2.5% on the upside before we even pause. And the other indicator that was particularly interesting to me was EEM last week, because I have some calls on, but B, because with all the bearishness and all the stories in China, what did it do? It closed the week right at its highs. So I think for next week, the important thing will be to break 39.93 and close above it, and then take another couple of weeks to get to 42.45, which is my target for this move. And this is not a small move, okay? In percentage terms, it's quite large. So that is what I'm looking for. Of course, it's not going to take a week, but I think if we close above 39.93 next week, with all this bearishness that's been going on because of China, this, that, and the other, that to me will be significant and will target this 42.25 area. In the US, and really the US is being dictated to by the NDX, all we have really is the monthly Bollingers to give us any idea where it's likely to stop and somehow retrace a little bit. As I keep on saying, it's very unusual for the American markets to close above the monthly Bollinger Band, but B, to stay above it and not retest the level that it overtook the Bollinger Band by. The Bollinger Bands comes in here, 18,105. When he gets there, it'll be 10, 15 higher, so immaterial. But that is the kind of level above that you want to really say, well, it's probably done enough for this month. And normally it exceeds it by 100, 200, and then comes down. So, you've got more or less the 18,300 level as the one where you do not want to be long of NDX for the rest of this month, and that you can be fairly confident that you'll be able to buy it cheaper. I'm not saying you need to short it. I'm just saying there's not a lot of point in holding it up there. That's all. And those levels have been exceeded in the Dow and in the SPX. So the move up if it happens, it's going to come from the NDX, but that, I'm not telling you anything you don't know already. This is the Dow over the NDX, DIA over NDX, and as you can see, it's now approaching the lowest levels ever, and I'm quite sure that it'll give everyone a nice fright by trading below it before it comes back. I really don't see any reason at the moment to not favor QQQ, the NDX. I think that trend will continue. And I can already see the headlines one day, and the Nasdaq exceeds the price of the Dow. Long way to go, right? For years and years and years, but I can see it happening. This is a trend I don't think is going to stop here. I think this is definitely, these stops down here are definitely going to get taken out. So for the time being, I'm playing the game like everyone else. I'm favoring the QQQs over everything else. All we can really do when we take out the all-time highs is look at the Bollinger Bands on the monthlies and just say, how far above are we? And as you can see, we're about 40, 50 ticks higher in the SPY, SPX than the Bollinger Bands. And you can see that that hardly ever lasts. We do go above them, but the month after we retest lower and basically slowly crawl up along these moving averages, which come back up. So I think what is likely to happen for the rest of the month is that we have jumps up in Dow and SPY, which get retraced and led basically by QQQ, which has another couple of percent to the upside before it retraces itself and forces everything else down. But at the moment, basically what every chart is telling me is don't fight the trend, just favor the ones that are not over the monthly moving averages, and that at the moment is Europe and actually, funnily enough, the QQQs. I've changed the levels where it was worth changing them, but I think the summary is quite clear. I'm not at all understanding what the bond market is doing or why it's doing it. And therefore, until I've seen the CPI, I won't be able to make a decision either way on which way I'm going to jump. But I do prefer Europe because logically, if the bond market is worried about the Taylor rule, it can only be worried about it in the US and not so much in Europe. And therefore, if I want to get long, I will do that in Europe from now on. But otherwise, no change in views. While the DBC is as weak as it is, and while oil is really not screaming and copper is as weak as it is, I really can't see that growth is going to be that strong that the Fed needs to change its dot plots, and therefore I'll stick to my knitting. Thank you very much indeed, and tweet to you tomorrow.